What's new in today's financial markets is that Leopold Aschenbrenner just got put out of business by Ken Griffin. What exactly did Leopold do to lose $45 billion this week? Getting major margin calls from most banks and actually being bought at a discount by Ken Griffin, who then drove markets higher after the buyout. This is a crazy form of market manipulation. Short sellers driving out traders who are in high leverage positions in highly volatile markets to then pick up their breadcrumbs and drive price high. It's sort of like a scene from Billions, where you see Axelrod squeeze out these other hedge funds, buy them out at a discount, and drive prices higher. This sort of thing happens in real life. There's always a bigger fish. But what exactly did Leopold forget for his fund to get liquidated that fast? He went from hedge fund to Wall Street bets in just less than a week. So I'm going to show you how to avoid risk like Leopold and actually trade like Ken Griffin to become the bigger fish. Number one, Leopold was using margin. Margin is a no-go, especially to a new investor. You don't want to be getting margin calls from your bank telling you that you have to pay off an excess amount that you have no money in, especially when you're all in on trading. What you should actually be doing is getting a job, investing, saving money, and avoiding high-risk leverage bets like Leopold. He was right in the sense that compute, data centers, and AI would be the next big thing, but he ran a completely one-sided spread and was not hedging his exposure. He was shorting against softwares that he thought AI would potentially harm, while also longing the whole narrative and theme of AI. So Ken Griffin, an institution, spotted him and said, this guy is a complete idiot. He's running a one-sided spread. His exposure is too lenient. If we offside software markets, buy them out, and we sell off semis, he would be knocked out. And that's exactly what happened. As evil as it is to say, war is actually one of the most profitable things to an investor. While the total public market has been losing, private markets have been gaining at a tremendous rates. But why is this? What exactly do oil markets price? A lot of people think that oil is just the price they pay when they fill up their car from point A to point B, but it's actually not just that. Oil markets price in a much greater fear signal. I'm going to show you how we trade oil markets, the discorrelation between tech and oil, something we can take advantage of, and financial instruments to be viewing during this time. You should be approaching this geopolitical tension as an investor, where things like this will always yield a short-term bearish result, sort of what we're in right now. But historically, markets have proven that war is bullish in the long term. So I'm going to be breaking down defense stocks that I myself have positions in, carried positions in the past, and why I've chosen these single stocks, especially during this time. So I've had multiple 5-figure days, even consistent 4-figure days, using this same exact strategy on oil, alongside my students who have earned multiple 4 figures and 5 figures in payouts. Some have even been denied max payouts by prop firms just because of how broken this strategy is. Aschenbrenner, the CEO of Situational Awareness, $20 million of early capital turned into a $45 billion book in only 22 months. Think about how crazy this is. Leopold, he has no trading background. He believes the narrative for this market in this coming market cycle heavily depends on AGI. He says that AGI is coming. That's his investment thesis. Was he wrong? No, he was just incorrectly positioned. And these are the mistakes you're going to learn from a lot of hedge funds and investors that lose their funds, is they don't know how to properly run their books. They don't know how to hedge their exposure. What Leopold was doing was he had a one-sided exposure wearing a hedge costume. So essentially, he was long semiconductors, memory, data centers, power, all of it. But he was short softwares that he thought AI would harm. The issue with this is he had no hedge. A hedge is a safety net. It's a what if. What if AI doesn't perform? What if, in this case, the Korean semi-market sells off, investor sentiment shifts? Well, I'm sure he thought of it, but he didn't know how to properly imply it. Correlation does not equal diversification. He had 6 different tickers, but they all ran under the same narrative. When that whole book shifted and the narrative flipped, his margin cooked him. This is how drawdown became liquidation. So all the events leading up to Leopold's liquidation started with the surprise rate hike chatter around Kevin Warsh. Citadel comes out, scares the market, thinking that we could possibly see rate hikes. Now, rate-sensitive stocks are falling, and right before our FOMC meeting, they tank. This forces Leopold out. He can't meet margin requirements, he gets the call, and Ken Griffin buys him out. This is exactly how it went. He just absorbed his book in less than a day. It was one of the largest emergency stock transfers in Wall Street history. Now, with the largest forced seller out of the market, the AI sector rebounded. SK Hynix went up 16%, SNDK went up 30%, MU 15%. Leopold was correct that this is the narrative, but he was incorrectly positioned. He didn't need to be less bullish. He just needed the other side of his thesis to be long as well. If he longed things such as like FactSet, Workday, or ServiceNow, he would have seen a nice little hedge on his portfolio. It's the same narrative, but both directions. About a month before the collapse, Ken Griffin was publicly speaking about the importance of managing exposure so you can sustain a loss. Here, as you could see in this clip that I'm about to show, as he hints at this market correction, telling you that you need to correctly position yourself within the market in case of these fat tail events.
You'll never manage your portfolio for every possible tail event, but you should stay very focused on like, what is the worst case scenario? Can I tolerate that loss? And monitor and maintain your exposures such that that loss is a tolerable loss. It may be an extreme loss, but it's still tolerable.
Now, the alleged squeeze says that Citadel was positioned short against most crowded AI names. Leopold also was positioned long in most public equities. The exact book everyone knew, Situational Awareness, was levered long, got cooked. And the confirmed part was that when the sale came in, Citadel was the buyer, and they absorbed $16 billion in just under 24 hours. What did Leopold do wrong? He had the right thesis, but now he has a dead fund. How can you avoid this mistake? So Leopold, well, at least in the market, you're getting paid for managing risk. You're not getting paid for being right. You can be right, but if you incorrectly manage your exposures, you're wrong at the end of the day. The market is not a game of, okay, I'm going to come in, do my research, and I'm going to get a couple stocks and I'm going to be right. No. How well can you manage your portfolio? How well can you manage those positions in terms of drawdown? How well can you manage them in terms of a market like a bull rally? Do you sell off while retail becomes greedy, or do you start adding more? You're getting paid on managing your book. You're not getting paid for being right. Exposure is the position. Your margin, your gross, your correlation, that's exposure. The book you're running, I should say, and how that book correlates to each other. If you're long gold, short tech, long oil, during periods of recession indicators, that's a good spread because you're betting against the market, all right? We're heading into a recession. But if the market has bottomed out, now you're short gold, short oil, the recession's over, let's say geopolitical tensions in Iran shoot down, you're good. But just understand, exposure is also correlation. It's the amount of money in your account and where you're positioned. So just know this, forced sellers fund liquid buyers. Every liquidation is someone else's entry. Think about it like this. Trading is a win-loss game. Every time someone loses, there's another guy on the other side winning. Leopold simply just lost to Ken Griffin. Who are you losing to? If you're trading prop firms, you're losing to the prop firm. If you're trading live markets, a dealer is most likely on the other side of your trade. And you, my friend, can die out just as fast as a $45 billion fund if you don't manage your risk correctly. Now, if you want to learn how to manage your risk correctly, down below in the bio, I linked a free PDF on risk modeling within trading from a quantitative stance. I firmly believe that quantitative trading is the only way to approach markets, and we should understand market fundamentals even before diving into that. But if you want to correctly model your portfolio, or you want to pass prop firm accounts a lot faster, click the link down below and learn today.